Hi everyone, Mrs. McGrath here. We're going to get started on our financial accounting for the spring semester. We're going to start with Chapter 1, where we'll go over the uses of accounting information and financial statements. The objectives for this chapter are to define accounting, identify business goals and activities, and describe the role of accounting in making informed business decisions and explaining the importance of ethics in accounting. We're also going to identify the many users of accounting information in society today. We're going to explain the importance of business transactions, the money measure concept, and the separate entity concepts as they relate to accounting measurement. We're going to describe the corporate form of business organization and describe the 4 financial statements and define the key components of those financial statements. Lastly, we will work on gathering an understanding or increasing our understanding of generally accepted accounting principles, otherwise known as GAAP, and understanding how they relate to the financial statements and the independent CPA's report, and identify organizations that actually influence GAAP. Our first objective is to define the accounting term, identify business goals and objectives, and describe the role of accounting in making informed decisions and understanding the importance of ethics in accounting. First, if we look at accounting as an information system, and why we need accounting. Accounting is needed to assist decision makers in making decisions. It provides a link between business activities and decision makers. Accountants focus on the ultimate needs of business decision makers that use the accounting information to help them make their decisions. These decision makers are either inside the company or outside the business. In a sense, accounting is not an end in and of itself, but it's an information system that helps us measure, process, and communicate financial information about identifiable economic activities that a business performs. Accounting supplies information to decision makers that they need to make reasoned choices among the alternative uses of what we call the scarce uses that a business has, the scarce resources that a business has that they need to make decisions about in order to conduct their business and ensure economically satisfying business activities. Accounting is actually what we call the link between businesses' activities and the decision makers. Accounting measures business activities by recording data about them for future use. It stores that data until it is needed and then processes it into useful information that can be communicated through reports to various different business decision makers. Data about business activities are the input into the accounting system, and the useful information is the outputs of accounting. If we look at this diagram at the right, we see that the business activities provide data that can be measured, processed, and then communicated in the form of information and reports that are then used by decision makers. All businesses have goals. They perform activities and then they measure those activities. Businesses can be defined as economic units that sell goods and services to customers at prices that provide an adequate return to the owners of that business. The goals of a business are twofold. The first goal is called profitability. Simply put, profitability is just revenue greater than expenses that result in a profit. Businesses must make enough money to pay all the costs of doing business and have money left over to stay in business, to support business growth, and to pay a return to the investors or the business owners. The second goal of businesses is liquidity or cash flow. Liquidity or cash flow are the ability to pay the business's bills and operate the business on a daily basis. A business must have enough cash available on a daily basis to pay their debts when they are due. Businesses achieve those goals, their two goals, by pursuing the activities of that business in a sound, well thought out fashion. Businesses pursue or achieve their goals through three primary ways. The first way is through financing activities. These are the activities that obtain the business capital from the owners via issuing stock in that business and creditors or borrowers, borrowing money from those creditors or borrowers, and then obviously repaying their creditors and hopefully returning a return to the owners via the form of dividends. The second type of business activities are called investing activities. Investing activities are the ways in which the business spends capital to utilize in producing productive assets that achieve the business's objectives. Buying and selling assets such as equipment and other financial instruments are used in the business to help grow that business and ensure its future longevity. The last set of activities are operating activities. These are the daily operations of the business, such as selling goods and services to customers, employing managers and workers, buying goods and producing them, buying products and producing them into goods, and or providing services and paying taxes. When we look at cash flow statements for our businesses later on in the quarter, we will see that the cash flow statement is actually broken down into these three different categories: the operating activities, the financing, and the investing activities. Financial analysis. Financial analysis is what helps businesses to determine whether the business is well managed and achieving its goals. Accounting helps business managers by providing the means for determining this information. Managers must understand and evaluate their measures, and the measures must be aligned to the goals of that business. There are often, with most businesses, multiple measures that are created to evaluate different business goals. So for instance, there might be profitability measures that help that business determine how profitable it is from period to period. There also might be liquidity measures to determine how liquid the business is and how able it is to repay its debts and pay its bills in a timely fashion. Those are cash flow measures. When the measures are created, they must be realistic and crafted to motivate managers to be able to achieve them. Managers must know exactly how to evaluate the business's success, how to determine whether they have achieved their success and goals, and how to determine where improvements can be made. One means of doing this is creating financial ratios. Financial ratios show the elements of the financial statements and how they relate to each other. We will spend a great deal of time this semester learning about financial ratios and understanding the elements of those financial ratios and how they impact the ratio and the achievement of the business's goals. An example of some ratios might be expenses to revenue. These we have already looked at when we've looked at the component percentages on our income statement. Another ratio is the ratio of money owed to the total resources that are controlled by the business. There are many ratios, and again, we will learn about those in detail as we progress through the semester. Accounting's role in assisting decision makers by measuring, processing, and communicating information is usually divided into two categories. The first is what we call management accounting. Management accounting is what we call the internal information that internal business decision makers utilize. So these are the people within the organization that gather and utilize the information that is generated from our accounting systems. It provides managers and employees with information regarding how they have done in the past and what they can expect in the future. It helps them to determine if they have met the goals of profitability and liquidity. It helps them to determine how much was sold, what costs were incurred, and make projections for future sales and costs. This is where we see businesses use what we call budget reports and operations reports. These budget and operations reports can be compared to each other and projected forward to help guide the business as it proceeds into the future. The second area is financial accounting. This relates to the direct financial interests of outside parties. So while management accounting is really relating to internal people within the organization, financial accounting is really relating to those outside the business. Those that have a financial interest, such as creditors or investors, those would be direct financial interests, as well as indirect financial interests, such as taxing authorities, maybe labor unions, the Securities and Exchange Commission, where every publicly held company has to provide their financial information. Customers might be interested in this information as well. And you think to yourself, well, why would a customer care about the financial information of a business? Well, for one thing, if you think about it from a very simplistic standpoint, let's say you go into a department store and it's the holidays and you decide to buy a gift card for your favorite teacher, for your favorite accounting teacher, and you want to make sure that that business isn't going to go out of business. So one thing you might try to do is make sure that they are, you haven't heard anything in the news that they're having any financial difficulties, because you might buy that gift card, and if the business goes out of business, then the gift card is no longer worth anything. One way that you can observe the financial information of a business is by looking at their financial statements. These are the reports that are used to evaluate the business and see whether it's achieving its business goals. So, you might say, what does this have to do with what we've done so far in accounting? Well, most of what we've done thus far in accounting really might be considered more along the lines of bookkeeping. Accounting itself includes the design of the information systems that meets the needs of its users. So the goals of accounting are to help analyze, interpret, and use accounting information and financial information, while bookkeeping is actually the mechanical and repetitive process of recording financial information and keeping financial records. Bookkeeping is really just a small part of accounting. So really what we've done thus far is really learned how to do the bookkeeping aspects of accounting, which is really just the basic day-to-day activities that go in to being able to analyze, interpret, and use information. One of the other means of helping us within the accounting world is through management information systems. These are interconnected computer systems that help to support the processing of data within an organization. In today's world, computer systems help to gather, organize, report, and communicate all of the accounting and financial information. These management information systems, or MIS as they're frequently referred to, provide a system for managing the flow of data to all parts of a business and the interested outside parties. When you're looking for jobs in the business world, management information systems jobs are really a fantastic opportunity for those people who like to operate at a higher level and try to take basic raw data and make it into useful information. So how does ethics play into the world of accounting? Well, ethics are the code of conduct that addresses whether actions are right or wrong. When an organization acts unethically by using false advertising or cheating customers, polluting the environment, or treating employees in an unfair fashion, it is not the organization that is responsible. It is the members of that organization, the management and employees, who have made conscious decisions to act in an unethical fashion. Their unethical actions reflect on that organization and how others perceive that organization. Ethics are important in preparing our financial reports within an organization. Users of reports must be able to depend upon and rely on the good faith of the people that are involved in their preparation. So if you remember when we reviewed the Enron movie, one of the big issues with Enron was their financial reporting. The management team within that organization were unethical in their accounting operations, and as a result, they eroded the good faith of those that were investing in them. Not only did they erode their good faith, millions of people lost millions of dollars as a result. The intentional reporting of misleading financial statements is called fraudulent financial reporting. Obviously, there are many motives behind fraudulent financial reporting. One motive would be to cover up financial weakness within an organization, to keep obtaining prices that are higher for their stock than they should be. Other reasons might be to meet the expectations of stockholders and analysts. Other reasons might be to obtain loans or other financing. And lastly, another reason for unethical financial reporting would be for the personal gain of those managers and or employees who would benefit personally from the improper financial reports. Fraudulent financial reporting actually results in the distortion of records, the falsification of transactions, or the misapplications of various or multiple accounting principles. In response to many of these unethical actions that were taking place in the business world, the government enacted the Sarbanes-Oxley Act. This law was put in place in 2002, primarily in response to the corporate scandals relating to Enron and WorldCom. Sarbanes-Oxley has two primary goals. First, it's to regulate financial reporting and the accounting profession. And secondly, the Securities and Exchange Commission created rules that require chief executive officers, and chief financial officers of corporations to swear that quarterly and annual statements are accurate and complete. As a result, companies' management has two primary obligations. They must express financial information that is accurate and not misleading or false, and if they violate these promises, they can suffer not only personally and publicly, but they can suffer criminal punishment and get financial sanctions and or go to prison. So that brings us to the end of Objective 1 for Chapter 1. So as we look back on Chapter 1, a question that I would have for you that you should be able to answer from this chapter is, what is the difference between profitability and liquidity? You must be able to explain this difference in order to ensure that you have grasped the two of the major concepts relating to this chapter, or this objective in the chapter. Additionally, you should be able to match each of these terms with one of the 4 definitions that follow. So each of these 8 terms you should be able to match to each of these 4 choices on the right. Now, let's move on to objective number 2, identifying the many users of accounting information in society. There are 2 main areas of accounting relating to the types of users of accounting information as indicated in the chart above. The people who use accounting information to make decisions basically fall into 3 main categories. Management, and these are all the different internal folks within management. And then outside users with a direct financial interest, and outside users with an indirect financial interest. So as we mentioned before, there are 2 main groups or categories of decision makers. The internal are under the management area, and then the external fall into external direct and external indirect. If we look at these in a little bit more detail, management, or the internal users, refer to the people who are responsible for ensuring that a company meets its goals of profitability and liquidity. The external users with a direct financial interest, are investors and creditors. Investors are the folks who have invested capital in the company, for instance, invested maybe in the stock of that company, and thus have what we call an ownership interest in the company. Creditors, on the other hand, are those who have provided direct financial interest into the company by lending the company money or delivering goods or services before being paid by the company. Businesses with indirect financial interest, or users with indirect financial interest, include taxing authorities and regulatory agencies. They could also include other parties, but these are 2 of the primary indirect financial interest financially interested parties. And this will continue. And regulatory agencies also include the Securities and Exchange Commission. And then other groups are labor unions, advisors to investors and creditors, consumer groups, customers, the general public, and economic planners. Now, we've talked a lot about all these publicly traded companies. How about accounting for governmental and not-for-profit entities? First of all, these types of organizations function by raising funds and then deploying those funds or scarce resources to provide services to others that might not otherwise be provided. These businesses represent more than 30% of the U.S. economy, so clearly they're significant. Many of you will actually probably get jobs that are either governmental or working for not-for-profit organizations. These businesses also must report business information for users, including both internal and external users, and perform many of the same functions as for-profit entity. However, some of the accounting rules within these entities are a little bit different than the for-profit entities that we will focus on this semester. So that ends our discussion for objective number 2. Our question here is, which decision makers use accounting information? And you can put your answer on your paper. You should also be able to match each term with one of the 3 types of users of that information. And that is the end of the notes for objectives 1 and 2 of Financial Accounting Chapter 1.